Okay, let's unpack this. Mid-December 2025 has delivered a genuine shockwave to the global system.
It really has. You've got these two huge, unstable stories just crashing into each other.
On one side, financial markets are trying to interpret a stream of U.S. economic data that's been, frankly, completely distorted by that 43-day government
Yeah.
shutdown from earlier this year.
And on the other, you have this sudden, really dramatic escalation of geopolitical tension right in the middle of a key global oil artery.
So today, we're doing a deep dive into the immediate aftermath of the U.S. announcement of a maritime blockade against Venezuela. We're going to look at the market's reaction. We'll dissect what the big central banks, the Fed, the Bank of England are doing.
And we have to figure out why the tech sector, which you'd think would be above all this, is completely locked in this battle between, AI optimism and some very cold, hard valuation skepticism.
Right.
The central theme you need to get your head around is just volatility. It's bordering on statistical chaos. The economic inputs we're getting are just not reliable.
The data is lying to us.
It is. You have this domestic confusion mixing dangerously with external military aggression. It creates an environment where, you can't trust the numbers and you definitely can't trust the headlines.
Let's start with that domestic confusion then. Because the U.S. labor figures for November, they were a perfect example of signals going in completely opposite directions.
Oh, completely. On the face of it, payroll growth came in at a surprising 64,000 jobs.
Which beat the forecasts, right, suggesting hiring hadn't completely fallen off a cliff.
And yet, that positive headline just, poof, dissolved almost instantly. That 64,000 gain was completely wiped out by a massive downward revision to the month before.
For October.
For October, the numbers were revised to show a staggering loss of 105,000 jobs. It was just statistical whiplash.
So if payrolls grew by 64,000, why did the headline unemployment rate still jump so sharply? It went to 4.6%. That seems totally counterintuitive.
Exactly. That's the highest rate we've seen since September of 2021. But if you really want to understand the economic pain, you have to look deeper. You have to look at the U6 rate.
The broader measure.
The broader measure, it captures people who've given up looking for work. And crucially, it captures people who can only find part-time work when they desperately need full-time.
So the quality of the jobs is falling.
The quality is failing. That's the key. People aren't losing their jobs in huge numbers yet, but the quality of available work is deteriorating very, very quickly.
That makes it sound like consumers would be pulling back. But then we get this surprisingly resilient retail sales data. Overall sales were flat, but the core number,
which is what feeds into GDP, it jumped 0.8%, a massive rebound.
How do you square that circle?
Well, that resilience is real, but it's probably fragile. And you have to put it in context. The sources we've seen suggest that some targeted fiscal interventions, you could even say politically motivated cash payments, might be propping this up.
Are you talking about the $1,776 warrior dividend?
Yes, that's exactly the kind of thing. It's an unusual, very specific cash payment that can inject a lot of money into the consumer ecosystem very quickly. It temporarily distorts the overall picture.
So you have to ask how much of that is real economic health and how much is just temporary government cash.
You do. Now let's layer in inflation because that gave the Fed a bit more breathing room.
We did get November inflation data, and it showed a clear downtrend.
A very positive signal. Headline CPI dropped to 2.7%. That's the lowest since last July and well below the forecast.
And core inflation followed.
It did. Fell to 2.6%, which is the lowest it's been since March of 2021.
Okay, so with all this messy, conflicting data, what was the Fed's posture?
The Fed had already been easing. They'd already cut rates 3 times this year for a total of 175 basis points since last September.
So after their December 10th meeting, what was the message?
The message was essentially, we're pausing. They signaled that policy is now in a broad range of estimates of its neutral value.
And when the Fed says neutral value, what are they really telling us?
They're telling the market that the aggressive cutting might be over. They think their policy is no longer actively slowing the economy down, so it lets them step back, wait, and see what happens.
And the Treasury Department actually had a pretty interesting theory about why unemployment hasn't spiked yet, even with hiring slowing down.
Yeah, their perspective is crucial. They're suggesting that labor supply and labor demand have actually softened together.
Oh.
Well, partially it's being attributed to changes in immigration enforcement, which reduces the number of new workers coming in. So you get modest hiring, but without that big spike in unemployment because the available labor pool has also shrunk. It's a very fragile equilibrium.
Speaking of central banks, the U.S. wasn't the only one getting good news on inflation. Let's pivot globally, see how this was playing out around December 18th.
The Bank of England was a big mover. They saw softer November inflation came in at 3.2%, and they felt confident enough to cut their benchmark rate to 3.75%.
Which is a big easing step aimed at their housing market, right?
Right. Mostly, yes. But here's the twist. A rate cut should be bad for a currency, but the British pound actually strengthened against the dollar right after.
Why would that happen?
Because the vote wasn't unanimous. Some members of the committee voted to hold rates steady. And that dissent, that little bit of hawkishness, it softened the market's perception that this was a fully dovish shift.
So they got their rate cut, but managed to signal they're still tough on inflation.
It's exactly. They're trying to have their cake and eat it too.
Meanwhile, the rest of Europe was just a mixed picture ahead of the ECB decision.
A complete patchwork. We saw PMI data showing German manufacturing, the engine of Europe, still declining. But French manufacturing actually grew. So the ECB was expected to, and did, just hold rates steady.
And in Asia, the Japanese yen was really the big story.
Oh, absolutely. The yen strengthened a lot against the dollar, pushing that USD-JPY pair down below 155.
Even though Japan had some good news on trade?
Right, their trade balance surprisingly swung to a surplus. But the currency's strength wasn't about current data, it was all about anticipation. The market is pricing in a potential Bank of Japan rate hike soon.
Which would narrow the yield difference with the U.S.
And that makes holding the yen much more attractive.
Okay, let's pivot from central banks to high-stakes military action. This is where it gets really interesting. On December 17th, the U.S. announced a total and complete blockade of sanctioned oil tankers going in or out of Venezuela.
It's a massive step, and for the markets, the crucial thing to understand is the legal gray zone the U.S. is now operating in.
What do you mean by that?
I mean, under international law, a peacetime blockade is considered a use of force. It's explicitly listed as an act of aggression.
So why hasn't it immediately triggered, an armed conflict?
Because the U.S. has been very careful with its wording. It stopped just short of declaring a formal naval blockade under the law of warfare. By keeping the target narrow, it only targets sanctioned tankers, and it only targets oil. A formal blockade has to be total and impartial, so they're projecting force, but they're trying to stay below the legal threshold for an actual state of war.
But the risk is still huge.
The risk is enormous. The experts we've studied are clear. If they seize a Venezuelan flag vessel or tighten this blockade, that would initiate an international armed conflict. And from Venezuela's perspective, this could already be seen as an armed attack, giving them the right to defend themselves. That's why traders are running for cover.
And you could see that flight to safety in the markets immediately.
Oh, absolutely. It was a massive flight to quality. Gold jumped almost 1%, closing around $4,343 an ounce. But even more telling was silver.
What happened with silver?
Silver hit a new record high of $66.53. This is what investors call the debasement trade.
Tell us more about that. Why is silver the best signal here?
The debasement trade is more than just hedging against inflation. It's a fear that central banks, faced with military tensions, will be forced to print enormous amounts of money to finance it all.
Eroding the value of paper currency.
Precisely. Silver hitting a new record high tells you that the fear of global political fragmentation and currency dilution is extremely acute right now.
And yet, counterintuitively, WTI oil futures actually fell.
Briefly, yes. That just reflects the push and pull in the energy market. You have the supply risk from the blockade, but it's being outweighed by the broader global weakness we talked about, the German slowdown, the soft U.S. labor market. The conflict risk hasn't created a big enough supply shock yet.
Let's shift to the equity markets. The S&P 500 dropped, driven by this phenomenon we're starting to call AI angst.
Yeah, the tech sector was under serious pressure. Giants like Nvidia, Alphabet, Broadcom, all down.
And the anxiety isn't that AI is failing.
No, not at all. It's that investors are questioning whether the dizzying valuations can actually be sustained. Can they be justified by real, broad-based productivity gains? It was a clear rotation out of those high valuation stocks that depend on future promises.
But there was one massive divergence inside the tech world that day. I'm talking about Micron Technology, MU.
Micron was the undeniable counter-narrative. The company reported record Q1 fiscal 2026 results, revenue at $13.64 billion, record operating cash flow. But here's the key number.
Go on.
Their cloud memory business unit reported a stunning 66% gross margin.
66% on memory chips.
Yes. And what that confirms is that while investors might be skeptical about AI applications, the software layer, the fundamental hardware demand for memory for the actual building blocks is intense and incredibly profitable.
So a flight to quality, even within the tech sector.
That's a great way to put it. Fleeing speculative software, flocking to fundamental hardware.
Moving beyond tech, we also saw some fascinating moves in biopharma M&A. It really tells you where big pharma is placing its bets.
The future is clearly in obesity and mental health. We saw Pfizer win what was called an epic bidding war against Novo Nordisk to acquire a company called Metsera for $9.8 billion.
And that was for their GLP-1 assets, which for listeners, that's the drug class behind the explosion in weight loss treatments.
Exactly. A nearly $10 billion bidding war tells you how big they think that market is. And then separately, AbbVie spent $1.2 billion to buy a psychedelic asset from a company called Gilgamesh.
So they're moving into neurotech, using psychedelics for mental health.
It signals a huge new frontier in drug development. They are clearly looking for novel treatments for what is a growing global crisis.
And finally, there was a really significant shift in corporate governance in the U.S.
Yes. The executive order targeting the proxy advisory industry. Specifically, it named ISS and Glass Lewis.
And this is huge because these two firms have immense power. They essentially tell big institutional investors how to vote on corporate matters.
They do, and the order is focused on what they're advising on. It directs federal agencies, the SEC, the FTC, to see if the advisors focus on non-pecuniary factors, violates their duties.
Non-pecuniary factors like DEI and ESG.
Correct. Diversity, equity, and inclusion, and environmental, social, and governance. This move could fundamentally reshape the proxy landscape, maybe forcing a return to a purely financial, profit-based voting model. It's a very direct intervention.
So wrapping this all up, what does this mean for you, the listener? We've seen a world that's just split in two. You have powerful, positive micro data, like Micron's record margins, clashing with this profound macro instability from the blockade.
Right. If you connect the dots, the U.S. economy is walking this incredibly fine line. It's balancing lower labor demand with lower labor supply, which gives the Fed room to pause. But all of that is completely overshadowed by Venezuela. That action introduces a systemic risk that's way bigger than just market uncertainty.
It's a threat to international law itself.
It is, and that's what's driving investors into hedges like gold and silver.
So the market on December 17th presented a really clear, fascinating choice. Do you bet on the unstoppable technological wave you see in Micron's profits, the huge demand for AI infrastructure? Or do you hedge against global political fragmentation, against a wartime commodity surge and a blockade that is right on the edge of an international armed conflict? That decision forces you to determine which risk the failure of AI hype or the breakdown of global trade is the greater one.